So, hello guys. So, let's continue solving for this comprehensive problem. Okay? So, in the past episode, we have concluded that the effective rate is actually 14%. And because of that, from here, we multiplied it with 1 plus interest rate minus 240,000. And we have arrived at the liability balance at the end of year 1 at 1,883,562. Now, since we suffered financial difficulty, we have these agreements with the creditor. So now, we will try to update our liability balance based on these three. Okay? So, let's consider first this first check, where we agreed to give up our land to settle half of our liabilities. So, one half of the liability balance is actually 941,781. And since we need to settle this liability, our entry is we debit loans payable 941,781 to decrease our loans. Now, the partner, since we are to give up our land, then we credit the land account for 700,000, which is the value recorded in our books or the book value, which means that we can only deduct up to that amount. We cannot use the fair value, which is 850,000, because if we do, then the land account will have a negative balance, which is not correct. Okay? So again, we cannot credit 850,000 because in our books, we only have a land balance of debit 700,000. And if we do credit 850,000, then the land account will have a credit balance of 150,000 or negative balance of 150,000, which is not correct. Okay? So, since in here the debit amount is greater, we have to recognize another account, which is gain on extinguishment of debt, which is the balancing figure 241,781. So, that's the entry related to check number 1. So now, let's go to this check number 2. And in here, we are to settle 1/4 of our liability by issuing shares or equity swap. So 1/4 of this one is 470,890.50. So the same with check number 1, debit loans payable, but for the amount of 470,890.50. And then credit ordinary share capital at par, of course, and it should be partnered with the ordinary share capital share premium. So the next one is the measurement of these two, if you still remembered, is based on first the fair value of the shares issued, but if it's not available, we have fair value of liability to be extinguished. And if that too is not available, then we have no choice but to measure these two at book value of the liability extinguished. And I hope you still remember that. Now, in this problem, the fair value of the shares is given, which is 15 per share. So, we're gonna use that. So, 20,000 shares times 15 per share equals 300,000. So, that's the value of these two accounts. And remember, this ordinary share capital account shall be measured at par value only. And since the par value is only 1, then the value of this account is 20,000 shares times 1. Again, that's 20,000. Okay? Now, the rest, which is 280,000 from this 300,000, shall be credited to OSC share premium account. And since the same with check number 1, the debit amount is still greater than the credit amounts, then we have to credit gain on extinguishment of debt as the balancing figure, and that is 170,890.5. Okay? So that's the whole entry related to this check number 2, which is pertaining to an equity swap. So, now, from this liability balance, we need to deduct this one and this one. Because again, Baby G paid in land and in shares also. Now, if we deduct these two, we will still have a balance of 470,890.5. And according to the problem, Baby G asked for modification of terms, specifically reduction of interest rate from 12% to 10%. So, because of that, there is still a chance that this liability balance will be changed if there is a substantial modification. Okay? So if there is no substantial modification, this balance will continue. So to know if ever there is substantial modification, we need to get the present value of the remaining payments. So the principal to be paid at the end of the maturity date is now reduced to 500,000 because 3/4 of the liability has already been paid. So that's 3/4 or 75% of 2 million, which is 1.5 million, which is why again, only 500,000 liability remains. Okay? Now as to interest, we have 10% instead of 12%, which is 500,000 times 10%, that's 50,000. Now, let's get the present value of these two future payments. So in getting that, we need to use the old effective rate, which is the 14%. And of course, the term that we are going to use, or the N, will be 4 years, or 4, because 1 year has already passed. Okay? Now, 1.14 raised to the power of negative 4, that is 0.59208, times 500,000, and we have a present value of 296,040. And as to here, we have a present value factor of 2.91371 times 50,000, and we have a present value of 145,686. So now we need to sum these two, and that will be 441,726. Okay? Now, to know if there is substantial modification, we need to get the difference of this old and new liability balance. And we will get 29,164.50. Now, let's divide it by the old liability balance, and we will have 0.061934. Or if converted into percentage, that's 6% plus. Okay? And since it is less than 10%, then we can conclude that there is no substantial modification. Okay? So, what are the effects on the accounting of this remaining liability? So, since there is no substantial modification, the good news is this old balance will not be changed into this one. However, the problem is we need to find a new rate that will be applied to this principal and interest payments in the future, so that the present value will become 470,890.50 instead of this. So, it means we need to do an interpolation. But let's do that in the next episode to keep this video short. So, if you can still follow, please click like, subscribe, and hit the notification bell to be updated on my next videos. So again, thank you for watching and see you on the next one.